If you have a side hustle, a Schedule C, like a little Etsy store, maybe an Uber driver, DoorDash, maybe you do consulting or coaching, or you sell online, and you're getting paid through PayPal, Venmo, or Stripe, this video is for you. Because the IRS doesn't need to come after you like in a movie. They don't need an agent with sunglasses following you around. They just need your tax return to not match what their system expects, or for the way you file to wave a bunch of red flags to bring their attention. No, they don't have to follow you. You're going to make yourself known to them. And that's why side hustles, side gigs, and sole proprietors get so much attention. It's easiest category to run through that automation. Sole proprietorship returns are audited 700%, 800%, 900%, over 1,000% more often than their corporate counterpart. And that's based on IRS data. No hyperbole, no guessing, raw data. And the sad part, it's a self-inflicted wound. Let me prove that to you with data. The IRS's own tax gap estimates show something that should stop every side hustler in their tracks. Misreporting of wages, W-2 income, is around 1%. But misreporting of sole proprietorship income, that Schedule C type income on your 1040, is about 55%. That's not my opinion. That's straight from the IRS tax gap numbers. And the Government Accountability Office says the IRS attributes about $80 billion of annual tax gap to sole proprietors underreporting their net business income. And unless you're working with someone who knows what they are doing, you are walking straight into a trap. The reality is the highest compliance income is W-2. The lowest compliance income is often Schedule C. And if you're the IRS trying to close the gap efficiently, you don't start where the compliance is already high. You start where the data says compliance is low. By the way, in the last year IRS published data for sole proprietors, not only were audit rates like 10 times higher than other business returns, but the taxpayers, these sole proprietors, lost their audits to the tune of 95%. The IRS absolutely hammered them. Now, I'm not here to scare you. I'm here to help you keep your deductions and keep your sanity and avoid getting snared in this trap. So spend the time to learn how to avoid a nasty audit. Oh, and keep more of your money while you're at it, right? Most side hustle problems aren't caused by people doing something illegal. It's because they're taking the wrong type of deduction on the wrong form and getting in trouble. The IRS uses things like something called Discriminant Function System. It's a scoring system. It's called the DIF score, and the unreported income DIF to choose returns with a high likelihood of overstating deductions and underreporting income. But that's not all. They also match reporting with what I'm going to discuss in a minute. So today I'm going to cover three things. Number one, how the IRS is actually finding side hustle issues, like how are they locating them? Number two, the biggest red flags, the home office, autos, meals, travel, the way people run their Schedule C business, we're going to go over those. The big red flags. Third, what you can do right now to keep your write-offs while dramatically reducing your risk. So let's start here. How does the IRS find side hustles? There are millions of returns, so how exactly are they landing on these types of businesses so often when compared to others? Well, let's start with the IRS matching game. The IRS has an automated process that compares what you report on your tax return to the information reported to the IRS by third parties. So you're all familiar with W-2s. We'll think 1099s, the new 1099K, 1099B, and so on. When the IRS sees a mismatch, one common result is something called a CP2000 notice. And important, a CP2000, these notices, it's not a bill. It's a proposal from the IRS. The IRS is saying, here's what we think happened based on the data that we have. Do you agree? And that's the first big shift you need to make. This is not a human agent choosing you. This is a system looking for discrepancies. So here's where a lot of people get trapped. They think, if I don't get a form, I don't owe tax. And that's not how it works. Forms are about reporting thresholds. They're about reporting income. Taxability is about whether you had taxable income. And it doesn't mean you got a form, right? You still have to report it. So don't report the income shown on a form. You're asking for issues. Don't report the income and you didn't get a form. You're still asking for an issue. But let's talk about the stuff that gets the most kind of play online. We're going to talk about red flags that cause an audit beyond simply not reporting the income and doing a mismatch. It's pretty simple. If someone reports $100,000 in 1099 income to you and you don't report it in your return, you're going to get hit. You're going to get a notice. But what about things that catch the attention of the IRS and trigger an all-out audit? And there are several, by the way. Let's go over red flag number 1, and that's the home office done wrong. The home office deduction is real. If you are a Schedule C sole proprietor, and I use those kind of interchangeably, and you're claiming the actual home office deduction, you're using a separate form only for sole proprietors, and that's called an 8829. And this is not only a red flag, but it's where people get crushed because they guess at square footage. They mix personal and business, and they don't keep clean documentation. And it's one of the fastest ways for a normal return to start looking off, especially for a small side hustle. There are 2 rules that matter if you're taking the home office deduction. Number 1, the space must be used regularly and exclusively for business. It must meet the principal place of business test or be used to meet clients, used for substantial administration work, and where you don't have another fixed location. And the most common mistake is this sort of exclusive, right? The desk is in the guest room. The guest room is also your Peloton room, and sometimes it's your kid's homework room. That's not exclusive. And when it's not exclusive, you just turned a good deduction into a bad fact pattern. So if you're waving a red flag at the IRS and probably tracking it wrong, right, you're asking for trouble. Remember, you have to prove the deduction. It's not on the IRS. If you fail to document it, you lose it. And sole proprietors lose, statistically, 94 to 95% of the time. So you know they're not keeping good records. But there is a way to avoid waving that big red flag and giving yourself, by the way, we can give ourselves some breathing room. It's called an accountable plan. We've all had one, by the way. Think of any job you've ever had. Your employer tells you to buy some donuts on the way to the office, and then they reimburse you. Well, where did you track that? Where did it go on your return? It didn't. The employer pays you, and the employer tracks it. In the case of a home office, your employer can reimburse you for the home office. You report it just like donuts, meaning it doesn't go on your return anywhere. There's no red flag. But you need an employer. You cannot be an employee of your own sole proprietorship. So you're going to need an S Corp or a C Corp. And yes, even a small, closely held S and C Corp, you can be an employee of your own corporation. So the easy upgrade is if your side hustle is making real profit, one of the cleanest ways to reduce red flags is moving to an S Corp and reimbursing legitimate expenses through a properly run accountable plan. This means the business reimburses you for documented business expenses. Home office, but it's also mileage, supplies, all those things. Do it right, and it's cleaner, more defensible, and you're not filing some home office form on your Schedule C, waving that red flag. No special tax form, just cash, and the business writes off the deduction. And it doesn't say home office, it just says lease expense. It gets better because your methodology for the deduction is actually much better if you're doing it this way. I prefer to use something called the room method, assuming you have a home office in a separate room. And this allows you to reimburse yourself a larger percentage of your home, which includes, by the way, depreciation, utilities. Even if you have it cleaned from that corporation, it can reimburse you a larger percentage. But hey, if you're small and you simply must file that 8829 as a sole proprietorship, then just be extra judicious and do the following. Yes, you'll do this under an accountable plan too when you reimburse yourself, but you'll be like 10 times more likely to have to defend this as a sole proprietor than as an S or a C Corp. 1, define the space carefully. It can be a whole room or a clearly defined area. Number 2, measure it. Know the square footage of the office area in the whole home. 3, document it. Take photos once a year, literally like, this is my space that I use. 4, keep a home office file with the expenses that you allocate, whether it's rent, because you can actually do home office in place you rent, or mortgage interest, if you're having to pay mortgage interest. It can reimburse you a portion of that. Property taxes, yep. Utilities, absolutely. Internet, yes. Insurance, yes. HOA, yes. Repairs, yes. Don't guess what these things are. Don't estimate. You need real figures for backup, and it can be a percentage of those things. Now, quick note. I'm not telling you not to use the deduction. I'm telling you to use it like a professional. And it is a red flag. So be careful. If you are a sole proprietor, that is a huge red flag. And it does not exist if you're doing an accountable plan and reimbursing yourself. All right, let's talk about red flag number 2. Vehicle deductions and over-expensing. This is the one that gets side hustlers in more trouble than almost anything else. And that's because people listen to idiots on TikTok talking about writing off their G-Wagon. They do one of these things. They claim 100% business use on a vehicle that obviously is also used personally. They write off a big vehicle purchase and can't support the business percentage. You'll learn more about that in a second. Or they don't keep a mileage log. They try to recreate it around tax time. That won't work. There is also recapture. This is huge. If you're using 100% depreciation on example, so for example, a business, anytime you drop below 50%, you're going to have recapture if you took a bigger deduction on the front end. That's 179 or 168K. That's all these TikTokers. We're going to write off the whole G-Wagon. It drops below 50% during its useful life, and you have recapture. You're getting nailed. If you want the car expense, here's what the IRS is going to expect you to do. You need contemporaneous records. The date, the starting odometer and end odometer of of miles on the car, the from, to, the business purpose, what was the client's, the business names. You need, every year you need a beginning and ending statement of your odometer. And you need the actual receipts for gas, repairs, insurance, registration. This means a mileage log or a tracking app, which is, I use MileIQ, that shows what are business and personal mileage. And this is where you get the percentage of business use. If the IRS sees 100%, be prepared to defend it. Like you are just asking for trouble because they can just deny the deduction. We're just disallowing it. It's your burden to show that you actually used it. And this is a big reality check. Things like commuting, that's not business miles. Driving from home to your regular job, not business miles. If you have a home office and you can actually mix that in, then you possibly could get some of those. If you're running personal errands, that's not business. The business doesn't just kind of magically become business because I say so. Hey, I'm talking to somebody on the phone. That's not how it works. You have to be doing the travel for your business. So how do you do this cleanly? Option A is you could use the standard mileage rate method. This requires you to track business miles. It's simple. It's 72.5 cents per mile in 2026, and it moves around, so always watch it. But you still track your mileage, but no more receipts. It's so much cleaner than dealing with that 50% or greater usage and having recapture. You're just getting reimbursed for the miles that you're using on the car. Option B, this is the actual expense method. This means you're tracking things like gas expense, repairs, insurance, depreciation, lease payments, and you still need that business use percentage. Social media screws up the rules. If you want to deduct that G-Wagon, you can only deduct the business percentage. So 60% business use means you get 60% of the expenses as a deduction, not 100%. And by the way, there are special limitations on certain cars. If it's a car below 6,000 vehicle weight, and that's unloaded, by the way, it's in a special category and it has a limitation. It's very limited on what you can deduct. There are also limitations for SUVs under Section 179. When they always say you can write it all off, no, you're using a combination of 179 and 168K. And there are nasty recapture rules if you sell that car. There are nasty recapture rules if the business use drops below 50%. Whatever the case, whether you're using option A or option B, you need that mileage log. And here's a couple tips on that. Use a mileage tracking app like MileIQ. It automatically tracks you via GPS. Keep a calendar of what you are doing and why driving was necessary. You actually need this. 2, don't claim 100% business use unless it's true and defensible. It better be a car specifically just for that business, and you better have a personal automobile. If you claim 100%, the obvious question is, do you have another vehicle for personal use? If the answer is no, that's a problem. The IRS will disallow everything if they don't believe you. 3, don't over-expense the vehicle relative to the business activities. If your side hustle makes $8,000 a year and you're claiming a giant auto write-off plus a home office plus a bunch of travel plus a bunch of meals, you look like a hobby, or worse, a tax shelter, which brings us to the 3rd red flag. Crazy expenses like meals and travel, even losses year after year. And I'm going to just kind of call these things sloppy Schedule Cs, sloppy sole proprietorships, and it's a trap. A sole proprietorship is not bad, but it's the easiest structure to run messy. Why? Because everything runs through you. You run it through your personal bank account, your personal credit card, you do random transfers, you mix receipts, and you get tempted to deduct meals while you're driving around town. Maybe a meal with your spouse, maybe meals with your kids. It's tempting, right? That trip to Hawaii? Sure. I did some business in Hawaii. I'll say I had a meeting or some other nonsense that I heard online from some guru. See what happens? Your personal expenses start to mix with the business. They cross over. And when you're mixed, your return looks mixed. This is where people get nailed on 2 things: underreporting income and overstating expenses. And yes, this is exactly why the IRS and the Government Accountability Office data points to sole proprietors as a major contributor to the tax gap. So what do? Here's the single best move you can make as a side hustler. Separate it. Separate everything. Separate the business into a structure like an LLC or a corporation with its own bank accounts, its own credit cards, etc. The business absolutely should have a separate checking account. Do not run it out of your personal. Separate your debit card, your credit card for the business, and it's completely separate from yours. Don't leave it to chance. Then follow the rules. Is there really a profit motive? What are the rules for travel? Make sure you follow them. What makes a meal a business expense? Follow it, then document it. If you don't document your expenses, they didn't happen. It's as easy as that. Document it, or it didn't happen. And it is so much easier when you run the business separately as a corporation, for example, or an LLC tax as a corporation, using an accountable plan, right? You're documenting your expenses as they're incurred, and you're reimbursing yourself. Once you start doing that, you're set. But if you absolutely must be a sole proprietor, it's a small business, and you know that extra structure, or maybe the extra return, you think it's going to cost you, and the tax benefits aren't there. If you absolutely must be a sole proprietorship, please keep separate books. It's a legally required requirement. A separate bank account, a separate credit card. Just make sure that you're at least an LLC so you're isolating liability. Here's a rule. The amount of respect you show your business is the same amount of respect the IRS will show your business. Let me repeat that. If you have so little respect for your business that you don't even open a separate bank account or keep its books separate, the IRS is going to disallow all of your deductions. The amount of respect you show your business is the same amount of respect the IRS will show your business. So the side hustle cleanup plan goes like this. Number 1, create an entity to run it under and separate your money. A separate bank account, separate credit card, all for the side hustle activity. Number 2, keep contemporaneous records. Books and records are required of any business. It doesn't matter whether you're a partnership, corporation, sole proprietor. The rule is the same. Don't wait until April to remember what happened in July, right? Make sure you're documenting these things, please, guys. Number 3, mileage log or it didn't happen. If you claim auto, you log auto. You gotta have the paper trail. Number 4, home office. Make sure you're defining it, you're measuring it, you're documenting it. There is no guessing. You want to have that backup, boom, you're good. Number 5, don't build a deduction stack that makes no sense. If your business income is small and your deductions are massive, expect questions. In fact, the tax code has a special rule called the hobby loss rule that the IRS will use on you if you're creating losses 3 out of 5 years. Number 6, upgrade your tax structure when it actually makes sense. S and C Corps are used by successful people for a reason. Oftentimes you're reducing your tax burden, you're unlocking a whole bunch of other benefits. If you are making real profit, you may be ready for a better plan, better entity structure, an accountable plan, retirement strategies, reimbursement systems, stuff like that is, not only is it legal and powerful and defensible, I mean, it just works better. And by the way, the key word here is defensible, because the IRS doesn't have to prove anything. You have to prove that you were entitled to that deduction. So here's the biggest takeaway. The best side hustle tax strategy isn't more write-offs, it's clean write-offs. Clean books, clean records, no sweat, just smooth sailing. And by the way, if you are somebody who has a side hustle and you want help and you want to talk to somebody about what it looks like to actually set that up correctly, get good bookkeeping, put it in the right entity, I'll put a link in the show notes where you can get a free consult, or just type the word consult into the comments and we'll absolutely send you a link and you can have a no obligation free consult with somebody who can give you, here's some of the benefits and here's what it looks like to do it right. Now, if you're also a side hustler, put what type of side hustle you run down in the comments. Let people know what you're doing and how you are running it. Did you hear any weird advice off of TikTok and you're doing some crazy stuff? Ask us and we will do our best to make sure that we respond. Our lawyers and accountants look at the comments all the time, as do I. All right, share this with somebody who needs it, like and subscribe, and I'll see you guys later.